Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be revisiting Huntington Ingalls Industries stock. I just covered this one a month ago, but it fell quite a lot today. And I want to review, how I managed to kind of avoid this type of decline. While sometimes unexpected things happen that can cause these kind of declines, other times, even if something isn't completely obvious, you can pick up on certain things and try to just get the statistics in your favor a little bit more. So I rewatched most of the video that I put out at the end of September. It was almost a month ago, it looked like. And the main thing that I pointed out with Huntington Ingalls was, well, first let's look really quickly at how far it's gone down. So this is on Seeking Alpha, a news headline here. I'll just run through it. So the stock plunges 25% today. I'll move my head. We'll see where it's at right now. 25%. So down 25% in one day. That's a lot. Sorry if you own this stock. It's always tough when you wake up and you lose a quarter of your money in one of the stocks that you own. So earnings came in very light, and way down from last year. So last year, $3.70 a share. This year, $2.50. I'm not what if that's it's probably like a 25% decline now, honestly. So you can see why the stock is reacting that way. Revenue down as well. So negative revenue growth year over year. So lots of things here. The foresight of the earnings that are coming from contracts and stuff, which is what I talked about in my last video, doesn't look like to be as good as it was in the past from analysts. So there's we have this uncertainty that they're talking about how much money they're going to be able to make. So what I want to point out is I didn't know that earnings or that the stock price was going to fall 25%. But the reason that I said I was avoiding the stock, and I don't even have like a buy price on it, is because when I calculated their earnings growth, I took into account share buybacks and the downturns that they had in the past since I think it was 2017. I think I had 8 years of data. Earnings had only grown 1.5% per year on average. So that's very low. It's lower than the rate of inflation. And the danger that comes when you have this situation is once earnings growth goes from slow to negative, the market will start extrapolating out the bad into the future. And so the tilt, while a tilt from, let's say they go from positive 1% earnings growth to what did revenues fall 2.4%. So let's say over the course of the next year, this shifts to minus 2.4. Well, before, if you extrapolate out 1.5% growth into the future, you're growing. Eventually, you get bigger and bigger and bigger. If you extrapolate out negative earnings growth, eventually you go bankrupt. So that shift, even though it's not particularly big in the big scheme of things, the direction of it, the market often, not always, but it will often treat it and extrapolate out that negativity so that in one day you can literally lose 25% of the value of a stock because the market is looking forward and extrapolating that growth out. Now, it's even worse in this case because I calculated my own earnings growth based on history. And because I found history is usually about 80% of the time, it's the best guide to use. So when I made my video just 1 month ago, analysts were saying that earnings growth was going to be 12% over the next 2 years. And so now we're getting news that it's not going to be 12%. It's going to be like negative something. So that huge shift is even more dramatic if you were optimistic about the next couple of years. And none of us knew what was going to happen ahead of time, or else the stock would have already adjusted by a certain amount. But you know when you get these setups like this, that the danger's higher. The danger's higher for a big drop. Now, if a company it depends on the valuation and stuff, but if a company goes from 8% growth, earnings growth to 5% earnings growth, usually the stock decline is not as bad when it goes from 2% positive to minus 1%. And so when I see earnings growth get into this kind of danger zone, which is negative real growth, I mean, with the inflation that we've had, but really anything under like 4% is pretty slow. Usually I think about if it's selling a stock, unless there's a reason, like unless there's a recession, if you know what the reason is and it's not company specific, then that's a different thing. Then you get into kind of different metrics for recessions and things like that. But if it's not in recession, if it's not an industry recession, there's not really a great explanation for it. If growth is slow, it's probably something fundamental with the company or the business or whatever. And I want the businesses of the stocks that I own to be growing at a pretty good rate most of the time. So I think that's the lesson so far with Huntington. We'll see what happens. In terms of whether to buy it now, I don't know what's going to happen over the short term. I know they weren't growing well going into this, so I don't really buy turnaround stocks too much. Now, some special situation came along at some point, and I looked at their cheap price. Maybe I could be convinced later. But for the most part, I just avoid turnarounds. Unless it's like a cyclical type of a thing, I want businesses that are growing faster than inflation. So I'm still not interested in buying it, even though it's cheaper, and even though the stock price might go up. I just don't feel like I have a good way to predict that they're going to grow at any kind of rate long term, because they weren't doing that even before this report. This doesn't include this report. This will probably be negative soon. So hopefully that helps you think about how you're approaching stock investing and when to avoid, or maybe you might want to avoid, some of these slower growth businesses. You can just see here that just general earnings growth was not growing very much, not keeping up really with inflation. I think on the fast graphs it was about the same rate as inflation, but you have to take into account like buybacks and these downturns and things like that too. Okay, actually that rate was assuming on the fast graph it was counting these 2 years, which are not going to happen now. So if you don't count those, it was 4%. All right, you can go watch my other video too. I rewatched it. I didn't sound too stupid, and it was pretty level-headed, I thought, and ended up being the right thing to not buy the stock earlier this month. Thanks for watching. If you found this useful, hit the subscribe button, hit the like button. I do tons of analysis videos on stocks, and I'm going to have a lot more to come later.